on paper you are a crorepati to say, but you're essentially not able to liquidate that holding to buy even a house if you want.
But people damage their lives. A lot of people don't think about stock markets are a way for money to flow from the less informed to the more informed, and that is the basis of the game.
I got a pop-up saying that 9 out of 10 F&O traders lose money.
This is good, this is bad, and they should raise like bam, 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 the thing. Low risk, high return. Biggest alarming words on the planet, low risk, high return. And a very famous economist once said, there's no free lunch. Let's discover this free lunch aspect of it, low risk, high return.
If he simply shifts this into this 25 lakh into say 5 FDs with small finance banks, your risk profile has actually gone from the cost of failure of a bank to the failure of the Central Bank of India.
Why are our kids not taught finance and economics as a mandatory subject if they are going to be of the voting age at some point?
What is the risk associated to this?
So I think typically the largest risk in these companies, I'm Abhishek, the co-founder of Altius Investech, and the world is really in a turmoil because people do not have access to the right set of investments. And we are essentially trying to solve for awareness, access, and quality of investments which are available to the retail investors.
So Abhishek, a lot of things. The retail investments, especially now in India, everyone is investing. I just met a friend after 10 years, and one of the first few questions he asked me is that a lot of people now are investing. Do you also invest? So let's get some clarity on investments, on the right kind of investments, and on all that.
So I think the largest problem with investment is it is done in silos, right? So say you have just started your job, you have started making some good money, and you are, say, having some spillover money. So you decide, let's go open an FD, let's go buy a house, let's go, this new mutual fund is around town and let's go and invest into it. But the largest problem which people are not really approaching is sort of taking this from a wholesome angle, that what stage am I? Do I really need to invest first in an FD or first in an equity? Do I first invest into a real estate property or do I look at a startup investment? Is my cash flow requirement from my investment portfolio going to match my cash flow need, which I'll have for the next 10, 15, 20 years? So I think that's one. And the other is the entire gamut of investments has been consolidated to a very few investment avenues. So if you ask, say, a random bloke, what are the investment options? Possibly he'll not come up with more than 4. So it'll be gold, property, mutual funds, and say for certain very aware people, maybe debt investing, right? But what people don't understand is that now there are a lot more options which are available in terms of alternate assets, which give you a enhanced risk and return profile, wherein even though you're not raising your risk profile by a lot, but you're actually enhancing your return profile significantly. So I think you're trying to solve 2 issues. One is the approach towards starting your investments. And the second is introducing new assets into that universe of investments which you think are asset classes.
This raises a lot of flags for me. I've been educated in finance, right? And our financial education is a cult. We have these set of beliefs which are like ironclad. This is good, this is bad. And this should raise like bam, 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 the thing. Low risk, high return. Biggest alarming words on the planet, low risk, high return. And a very famous economist once said, there's no free lunch. Let's discover this free lunch aspect of it, low risk, high return. What are you doing, Abhishek?
So it's not really low risk, high returns. It's more on the lines of out of say 3 assets, finding that asset which has a lower risk profile while giving you a higher return. Right? So just to capture, say, a couple of very small and easy examples of these, let's take asset classes one by one. So say, if we take FDs, for example, a typical person would have invested, say, 10, 20, 30, 40 lakhs in one single bank branch where he has a savings account. And that is his entire exposure to FD. Typically, if he's using a large private bank, the likes of ICICI, Axis, HDFC, he would be having, in the current interest rate scenario, maybe a 6.5 to a 7.1 kind of a return profile. Now, if he simply shifts this into this 25 lakh into, say, 5 FDs with small finance banks, which are giving you almost in today's date 8.2, 8.5% per annum return, your risk profile is even lower than your return than your investment with an Axis or a Kotak, because RBI guarantees your first 5 lakhs of return. So even though your return profile has improved by 1.5% per annum, and that's over a long period of time, your risk profile has actually gone from the cost of failure of a bank to the failure of the Central Bank of India. And those are two very different aspects. I mean, the risk has probably gone down by like 100. So there are like umpteen examples of such scenarios present. Let me give you one of the examples which we had worked on, 6-7 years back. So there were two bonds which had come up close to each other. One was by LIC, which was an investment plan called Bima Nivesh, and the other was an issue by NABARD, right? I think Bima Nivesh was yielding a LIC guaranteed return of around 6.2%, and the NABARD bond was yielding a return of around 7.5%. So a differential alpha of 1.3%. The LIC issue was a 2,500 crore issue, which got subscribed within a period of 7 days. And the NABARD took almost a month to get subscribed. It was also a similar sized issue. Now, what was surprising was, out of the 2,500 crores which LIC had raised, 800 crores was invested into the NABARD bond itself, right? So what you actually realize is that the investment manager or your investment advisor is essentially selling you the product which has the highest commission and not essentially the highest risk return profile. Or he might not simply be aware that there is a superior product available in the market. Because he's a one-man show, he's also doing your execution, he's also managing his own life, and he's also trying to sort of analyze and understand all of the different investment products which are getting created and produced on a daily basis. So it's essentially a tricky subject, and therefore what we have seen when we speak to clients, when we analyze their portfolios, is a lot of people are stuck in suboptimal investments, wherein with the same risk profile or even a lower risk profile, we could have gotten them easily a return excess of 1 to 2% annualized, which can have an impact of maybe like a 100% impact on corpus. So maybe they invested over a period of 15, 17 years. 13% return will give you a corpus of, I don't know, maybe 15 crores, but a 17% return can actually give you a corpus of maybe 30 crores. So the impact is that huge.
So it's an information problem, according to you, because what you're saying is there is no efficiency of information transfer.
One, efficiency, and the other, intent. Why are there so many people selling digital gold, but very few people who promote sovereign gold bonds? Even though sovereign gold bonds are an extremely efficient method to invest in gold, you are getting RBI guarantee, you do not have the risk of storage, you do not have a third-party risk, you're getting a 2.5% interest per annum, you're getting a 50 rupee discount per gram on gold. Whereas with digital gold, you have none of these benefits, you do not have a tax exemption. But the likes of JAR, the likes of so many different startups are out there selling digital gold, simply because the commissions are insane on that. I mean, the companies which help you invest in digital gold get almost 2.5-3% of the investments they generate. So it is not just awareness, it is also what is being sold to you. Like, there is no one who's championing ETFs and passive funds because there is no money to market those instruments. So I think that is where digital platforms can play a role, because essentially there is very little cost of spreading information. So in a sense, you cannot expect a individual advisor to do this because he has to run his business, he has to generate an income for himself. But say a larger platform who can play at scale can actually solve these issues.
So the reason I smiled while you were talking about this whole ETF and passive fund thing is because, again, Akhil and I had done this episode on index funds, I think sometime in January or February, where we looked at index funds and we were like, for someone who just wants to invest without really thinking about it and doesn't really want to get into the nitty-gritties, reading about, annual reports and companies and understanding, what is the thing, which is a good company to invest in, what is my risk like. We were like, the best thing to do is to invest in an index fund because, again, your index fund is usually tied to a benchmark index of the country, and country does well, the benchmark index does well, and then so the index fund does well. So this just goes back to that what you're saying is, again, tying back to, again, what Akhil said at the very beginning, that you don't get a free lunch. Every single investment advisor that you have eventually is doing what they're doing to get that whatever 2%, 3%, 1%, whatever their commission rate is. So they are obviously going to go towards the things that will obviously get them their sort of commission.
But the free lunch is here because of governance. When you say that, buy an RBI-backed bond, then RBI is the government which is backing the bond using tax money. Or when you say that the FD for a smaller bank gives you a higher return, but it is backed up to 5 lakh rupees by RBI, again, it's government money backing investment for regular folk, right? So that causes that free lunch friction where it's actually the regulation that comes into play.
What I was hinting at was, this is one of the methods. Obviously, even if you leave the government aside, even if I take, say, multiple bonds which are available in the market, there'll be scenarios wherein the most popular bond does not really have the best risk-reward ratio. Even if you compare in terms of how it is collateralized, even if you compare in terms of credit ratings. So there's always ways to improve someone's portfolio rather than just investing in a particular asset class. So even if I say I want to dedicate some money to debt, now I can do a debt PMS, I can do a AIF, I can do direct bond investing. Now, typically, what gets sold essentially is the product which has the highest either commission or the highest availability, in the sense that it is marketed well. But there are a lot of options which are still available even without, say, a government intervention, wherein the product itself is actually superior, and because it's not getting marketed that well, there is a superior return profile attached to that product.
So increasing emotional input into an asset generally increases its price point, right? Which is one of the factors, which is one of the, let's call it like the groundwork factors for IPOs. Because initially there are 5 very well-educated, constituencies which say, okay, your company is worth this much because I have ran your financial models, I have ran this, I have seen the other multiples. When you get into the IPO market, you have all the 100 CR people of India or 140 CR people of India or whatever the number is. All of them can be like, oh, this company looks good. I'll buy it. Oh, it just looks like a 5 rupee stock. It's nothing. Let me get it. Nobody even thinks further than that, right? So there's like an information overturn there. I want to use this as a segue into what you're doing, which looks very interesting based on your website. So I want you to expand on the alternate asset class that you are willing to provide people.
So I'll take this from the start, as in where did we start and then where are we now? So typically when we started, we were in the wealth space for a while. So we ran a full-fledged brokerage house wherein we were direct members of all of the exchanges. We had MCX, commodities, currencies, stocks, MS, everything was in-house. Typically, in this journey, somewhere down the line, we started getting certain opportunities wherein we got access to companies which were not listed right now, but were going to get listed within the next 3 to 4 to 5 years. And these companies, if you compare to their peers in the listed space, were available at a fair amount of discount. And we started getting access to these companies, and we started investing our own personal money into this. And typically, while we were doing that, we also started getting a lot of client interest into such investments. And slowly and steadily, what we realized that this is again an asset class which is new for a individual investor, but it is very commonplace for an institutional investor, right? So a private equity guy or a VC guy is essentially what he's doing, right? He's getting access to a company early when it is not so popular or it is not very well known in the capital market circle. And he's holding on to it for the next 3 to 4 to 5 years. And at that point of time, when the company goes for an IPO, the liquidity unlocking happens. The company gets onto the radar of so many other investment analysts. He's able to generate a higher return because there's a PE expansion. So if the company goes from 18p to a 25p, which might be the market PE, also the company would have grown in size in terms of its earnings. And therefore, in contrast to say a public market investments, the person is able to generate a 10-15% alpha on an annualized basis. So instead of say generating 15%, 16% CAGR, you're able to generate a 23-24% CAGR, which is typically what PE firms are able to generate. So our idea was to give access to people of such opportunities wherein either the company is fairly large, it's a large consumer-based brand, or it is backed by one of the larger corporates, larger institutions in India, and therefore the IPO is fairly likely. Or it is in itself in an industry wherein it's a very sunrise industry, in the sense we know that it is small today, but maybe in the next 6 years, it will be a completely different animal. And so I think at this stage, to give you some examples out of the companies which we work with. So companies like OMDC, companies like ICICI Lombard, ICICI Prudential, Nazara Technologies, Barbecue Nation. So with all of these companies, we would have entered at maybe 15 to 20% of the IPO price. And we would have, on an average, held these companies anywhere between 2 to 5 years. So typically what we are trying to do is find companies wherein, say, either a PE has entered or a VC has entered, or it is backed by a very large institution. And in all of these triggers or all of these markers, give us an indication that the company is going to go for a liquidity event sometime soon. It might not be 2 years, it might not be 3 years, but within, say, a 4 to 5 year timeline, it will go for a public listing. And we target these companies when they are slightly unknown. Therefore, they have a liquidity discount attached to them. Plus, they are also scaling up very quickly. Typically, ICICI Lombard, we started the first couple of trades at 60 rupees. The company got listed at around 645. Nazara, we started at around 300, 340 rupees. It got listed at 1500 rupees. Post that, it went to 3000, but that's a different story. And if I look at each of these companies, there was a very clear indication onto why they got shortlisted. So Nazara, Barbecue, both of them counted Rakesh Jhanjhanwala as a early investor in the unlisted space or in the pre IPO space. So when such a stock market veteran is there in the cap table of a company, you can have a fair amount of certainty that, the value unlocking might take time, but it is due. It will happen when it is due. So therefore, we got invested into that. With ICICI Prudential Lombard, it was the ICICI brand which was attached to it. So we were aware that, while it might be in the private space for a while, but because the brand attached is so worthy, it will go for a listing at some point of time. So quickly, this is what we used to do. When we started doing this in the decade of 2015 onwards, we started getting a lot of cases wherein the sellers were no more institutions, but they were actually ESOP holders. So in the sense that post 2012, 2013, post the Infosys boom, a lot of companies started issuing ESOPs. And these ESOPs also aged, right? So say you got an ESOP when you joined a company in 2012, but by 2017, 2018, that company maybe quadrupled or maybe went 100x in valuation. So on paper, you are a crorepati to say, but you're essentially not able to liquidate that holding to buy even a house if you want. So we started developing a marketplace of sorts, which allowed companies on one side and its employees who are holding shares, and investors on the other side who are actually having a certain risk profile to invest into these companies. And in this manner, we worked in a lot of startups. We worked in a lot of large companies as well. So for example, with Paytm, with Zomato, with Policy Bazaar, with Lux Industries, with Barbecue Nation, we worked with a lot of ESOP holders, right? And when we approached them, they had actually, some of them had actually joined the companies in its absolute infancy. So, think about someone who had joined Paytm in 2006. very middle class Delhi College of Engineering graduate who joined, Paytm in 2006, worked there for 3 years and then quit and then started doing something else. But when we spoke to him somewhere around 2019, 2020, what we realized is that on paper, he was holding Paytm stock worth 50 crores. And he actually wanted to buy a house and he was not able to do it. So what we felt that there is also a huge liquidity gap in the sense that there is no one bridging pools of liquidity with, people who are holding stock and who are looking to sell it out. So we started building a platform which allows, people to do a bilateral trade in the sense that for people who are holding ESOPs, for angel investors, for promoters and founders of companies to list their capital with us. And on the other side, have HNI, UHNI investors who have a slightly elevated risk return profile and are able to, commit capital for a slightly longer time span. So this is the core business which we have built over the years. Essentially, one, getting opportunities which were otherwise inaccessible, and second, building a platform which allows companies which have not gone for an IPO to still have some liquidity in their equity pool. Now, when we were doing this and we were taking these investments to the public, what we realized is that a lot of other alternate asset classes had mushroomed. So while we take Pre IPO on the one side, on the debt there was P2P lending which had come up in the last 5 years. Now, P2P lending, to give you a small background, it's basically peer-to-peer lending, which essentially is a miniaturized version of a bank, and the license is given by RBI to an NBFC, and you are able to generate a 2 to 3% alpha over what a bank would return to you. And this is also a fairly regulated body. There are rules which have been put in place by RBI to regulate these bodies. So that became a good investment avenue, which was still a little unexplored. Similarly, bond market in India was at a stage wherein it was attracting not just institutional capital, but retail capital as well. So we started looking at companies who were, or startups who were solving for, making the bond market accessible. Similarly, you would have heard of companies who are working towards making Grade A leased office spaces available for investing to retail investors in ticket sizes of 10, 15 lakhs. So that was mushrooming. And what we realized that is typically the class of investors who's working with us, they were generally interested in all of these other products as well. So we started working on a platform which allowed people to get access to all these 3-4 different investing opportunities in one single platform. And, smoothening his life and his investments by a significant measure. Now, once we were able to get all of these assets onboarded is when we started working on a unified platform which also allows you to actively look at your investments from a bird's eye view, understand what your allocation should be, work with advisors who are there with us, and understand, considering your deployable capital, considering your age, considering your cash flow needs, which asset class should you be deploying what amount of capital. So a very long answer to a very short question, but this is what our journey has been like.
Abhishek, there's so much there. So I think the first part that I want to look into is where you were talking about investing in companies who are not yet listed and who will be listing in the next 2, 3, 4, 5 years. So your method there was more about the people associated to those companies and the companies associated to those companies. Essentially, your way of establishing credibility in a Nazara or a Barbecue Nation was the person who had entered. You were like, okay, I trust this person's judgment. I trust this person's, credibility, and I'm basing my judgment off of his or her credibility. So what is the risk like? You say these are lower risk, or these are, a little more assured in terms of you're providing a company which needs liquidity before it's actually getting into the public market. You're providing it that liquidity, and because you're providing it that liquidity, you're getting, you're getting more for your for each rupee that you're putting in. But what is the risk associated to this? I'm sure today Rakesh Jhunjhunwala erstwhile Rakesh Jhunjhunwala is not 100% hit rate, right? He also does have his ups and downs. He is human. So what is the risk there and how do you handle that?
So I think typically the largest risk in these companies, apart from what you would have in, say, any other equity investment, would be a holding period risk, right? So because the companies which we are working with are fairly large, so a business risk is there with any investment which you make in the equity space. A risk of the government changing regulations and therefore the company getting impacted is again there for all the companies. So what is different is in a listed company, you could have decided to sell those stocks at any given point of time. And with a very low impact cost, you'll actually be able to execute that investment liquidation. Here, that might not be the ideal scenario because the liquidity might not be that high that you'll be able to get out with a very low impact cost. You will be able to get out, but there might be a high impact cost attached to that. Right? So typically, when we look at the companies which are in the pre-IPO space, these are not early stage companies, right? So there is no survivability question which we are trying to answer. So with a Nazara or with a barbecue, I was not trying to determine whether this business model is logical. क्या कल वो company चलेगी नहीं चलेगी? That is not what I'm trying to answer. I'm just trying to answer is how fast this will go and how soon will I be able to get a multiple on my money. If I was doing this with early stage companies, wherein say a seed or a pre-series A or a series A kind of a company, there I would have a very different risk profile attached to investing. So, I mean, holding period is essentially the largest risk, and therefore, for people investing in this, ideally you should not park money which you would suddenly need access to in the near future. So, the ideal holding period, what we suggest to our investors is you should at least have zero usage of that money for the next 2 to 3 years. And that is the that is the timeline which is required for the unlocking to happen. That is when the company might do a couple of follow-on rounds. It might increase its earnings by, 20, 30, 40%. It might file its DRHP showing that it has an intent to go for an IPO. And that is where it, comes into the spotlight.
So the example that's coming to my brain is like if you look at an airplane. So a pre-seed or a seed round company is like an airplane that you don't know whether it's going to fly or not.
True.
These companies which you're investing in is that you know it's going to fly. But if you have to go from Calcutta to Delhi, you don't know when it's going to get to Delhi. It can stop in Banaras, it can stop in Lucknow, it can stop along the way. You don't know when it's actually getting to its destination. But you know that eventually, thanks to the people associated to it, thanks to the organizations associated to it, it is eventually going to reach its destination and it's eventually going to give you that return.
In the US, Abhishek, there are these bunch of people, they're called accredited investors. Right? I am unaware of the Indian system of accredited investments. The tool that you're talking about or the asset class that you're talking about is higher up in risk profile than a regular equity investment because of lack of the information that is also conveyed by these companies to the public. There's a lot of hidden factors there. And you do not get the 8Ks, you do not get the 10Ks, you don't get the S4s. Right? You don't get the statements which would define a lot of factors that you would like to know as an investor. To be an accredited investor, either you have a lot of money flowing in, maybe you're making $200K a year, $200,000 a year, or you have $1 million parked in a bank account or in your personal investments, right? Or you have to pass an exam, which would say that, okay, you understand money and you will not die. When you talk about the Indian investor in this particular asset class, which is non-centralized, which is outside the market, which is centralized around your company, let's say, what kind of a person can invest? Are there any regulations protecting these people? And do you see any regulation in the future that might come into play once you, and hopefully you do after this podcast, because, millions will watch, but once you do get popularized, then.
Sure. So I think typically there are two vehicles to invest into such companies. One is an AIF, which is an alternative investment fund. And the other is a direct investment into the cap table of such a company. So if you were to invest into an AIF, there are certain minimum ticket sizes which you need to adhere to. And the other way to invest is obviously a direct investment. So India does not yet have a definition of an accredited investor, either in terms of the assets which you own or in terms of the net worth that you have. This is gonna come in. So there has been a discussion paper which has been started by SEBI, but I think it will take another 12 to 24 months for it to get enacted into law. Once it is there, then we'll have to rework as to who is now eligible to invest as per the revised norms. But till date, either you can invest directly with no minimum ticket sizes, or you can choose to invest via a fund adhering to the minimum ticket sizes which have been defined in the norms for those funds.
Interesting. And when you talk about, I am providing a secondary market for people who own ESOP shares, let's call them. So for people who have these non-listed company shares, the people who are going to buy these non-listed company shares from you, the main risk is my holding period time, because even the ESOP people can only get out once the company is public. You are trying to provide them with a secondary market to do so, and you're trying to reduce the risk of the holding period by giving them more liquidity. I want you to talk about that liquidity. Is it only at the time of exits? Is it only at the time of money raises? Is it at any time? If it is at any time, how do you price them? Because there's no demand supply curve, right? So what are you doing?
So typically when we run a platform, essentially the platform itself sort of solves for the liquidity issue, right? So currently we do not have a lock-in period for any investor who's coming into a late-stage pre IPO investment. So you could have invested today, and if say the stock went up, you could have divested tomorrow as well. How do we get this going? Over the years, as we have grown and as we have gotten more and more people attracted to this asset class, there has become a steady pool of capital which is coming into an investment, and a certain supply pool also, wherein people who would have invested earlier would have made certain return are now looking to exit as well. Plus, obviously, there is the ESOP pool which also acts as a supply parameter. And this entire demand and supply management happens through the platform which we have developed, wherein a buyer can also come in and punch his requirement, and a seller can also come in and punch his requirement. And the platform is also able to, with the help of certain algorithms, give us a certain understanding as to how should the asset be priced to ensure the transaction can happen. Now, this is not exactly like how an exchange works, because there is no price matching and there is no clearing corp wherein, say, someone is paying in and the other one is transferring the shares and then the clearing corp is doing the exchange. It is more similar to how a real estate property gets sold. So while there is no rate chart that, this apartment is now worth X, but broadly you, the buyer and the seller, both have an idea that if there's a flat in an area X in a building Y, so that maybe has a rate of say 8,000 per square feet, something like that. So it's something similar to that. Typically, the pricing is a mix of relative valuation. If there is a listed peer, essentially you can do a PE multiple check and you can understand that you're buying something at a reasonable valuation. Second, there is a recent transaction check. So say if it is a startup, they might have raised funds, they might be planning to raise funds. In both of these cases, you'll get a certain benchmark as to, what is the last fundraise or what is the next expected fundraise. And the third is demand and supply. So culmination of all of these three factors is what, leads to the final pricing on the platform.
So again, now I'm going back to this whole valuation thing and everything like that. So again, past few years, a lot of high valuations, a lot of very inflated valuations, a lot of funding flowing into the market. There's a lot of stuff that happened 2020, 2021. It was like, everyone and everybody was getting funded. 2022 funding sort of dried up, valuations changed. 2023, that's sort of consolidated. How has that affected you guys? How have you guys adjusted to that? And what are the changes that you have made, or what was the, as you were saying, you do a relative comparison, right? So how were your relative comparisons affected during this period?
So I think whenever you're investing into equity, stock selection is possibly the most important aspect that you need to handle. So even in the listed space, if you pick a company which is at a very steep valuation, or if the pricing is unjustified, you're bound to lose money, right? And that is what had happened here. But I think what was critically different between, especially the tech meltdown, which happened both in US and in India, and what happens otherwise, is people did not know how to value these companies. Like, for example, if you still ask me, how do you value Zomato? I'm not really sure, because there is no comparative for me to evaluate. It's anyone's call, You think that the GMV might rise for the next 20 years and therefore the cost might remain same and therefore they might make a profit. And therefore maybe in the year 2035, they might be able to turn a sensible profit. But that might change because they might decide to burn more money in, quick commerce over the next 3-4 years. So what we have maintained as a philosophy is, for people who don't understand a specific space, stick to your circle of competence. So don't go and try and invest into companies which are just the flavor of the month, or they are simply the ones which are getting all of the fundraisers, unless you really understand the company. And I think that is specifically what went wrong, especially during the IPOs of companies like Zomato, Nykaa, Policy Bazaar, wherein a lot of people entered assuming that there was still a lot of juice left into the company, and therefore the IPO will post the IPO, the company will still keep on rising to higher heights. Typically, what happens in the pre-IPO space is, because you are getting in at pricings of the last investor or very close to the last private investor, you have a slightly lower risk of entering at a steep valuation. So in the sense that, say, if you invest in a company wherein, say, Tiger Global had last invested, and if you're entering, say, at maybe a 5-10% premium, so that reduces your risk essentially of paying a higher price. Whereas when this company actually goes for an IPO, they will try and extract the highest price possible from the IPO, so that they are able to get the maximum return to their VCs and the founders. So essentially, this asset class, because you're investing early, you're able to get into an investment a little earlier into the timeline and at a little more logical valuation, and therefore negate a certain percentage of that risk. And the other aspect is, for companies when you don't understand the metrics, you just have to stay away. Otherwise you're bound to go wrong.
Abhishek, I relate to you quite a bit when you say you still don't understand where the value of a Zomato comes in. Because obviously there's certain fundamentals. And as Akhil said, finance is like a cult. There's a lot of people who believe in this fundamental game and like all that. So recently in India, railway stocks have been doing very, very well. And this is based on the whole, the tragedy that happened in Odisha, where there was a massive accident and there's a lot of people who passed away and massive casualties, and there's a lot of repercussions based on that. So thanks to that, there's this system called the Kavach that is going to be installed all over India. So there are certain companies who are being spoken about where they say they are manufacturing certain parts, or they're banking on the rollout of this Kavach system. Now, I was looking at a certain company very recently where they are currently doing revenues of under 4 crore a year. And they are hoping to do revenue upwards of a few thousand crores in the coming couple of years. And based on this future value that they seem to have, they were looking to raise money, and they were looking to raise money which was outside of the market. They were looking to do a money raise. In terms of the market, their share price from the 1st of August to today has gone almost, I would say, it's gone to about 160 odd % of what it was on the 1st of August. And this is based on a company which is doing 4 crores of revenue a year, not even 4 crores of profit. How do you look at a company like this? Where does your bullshit meter go off? Like, my bullshit meter was going all over the place, but there's definitely people who are banking on this and you are putting money into this, obviously, because otherwise there's no way that pricing can increase in such a way. And so where does your bullshit meter go on this?
Absolutely. I think a rising tide raises all boats, for that matter. And I think that is what happened with a lot of railway stocks also. So even stocks which had no relation with, with the orders which are going to come from the government also saw a very steep hike in their share prices. So what the way to look at these companies is whether that company is actually benefiting from the changes in the government. Now, the company which you're talking about might actually be one of those who has scored a very big order from the government, and therefore it is actually set for the next 10 years. And they will actually, irrespective of how the economy does, they'll have a very steady order line, and therefore they'll have a healthy top line, healthy bottom line, and therefore the pricing might be justified. But what you would have seen even earlier is, I think when Tesla was planning to come into India, there were certain stocks who had just Tesla connections in their names. They went up by 100, 200, 300%. When during COVID, there was a shortage of oxygen, stocks, even an NBFC bank, which had exactly. Like, it wasn't it was an NBFC, so it used to lend money. It had absolutely no relation to oxygen per se, and that stock for some reason doubled. So, I mean, that's just euphoria. That's the nature of the markets. You can't help that. People, when they're optimistic, they're super optimistic. When they're pessimistic, they're super pessimistic. But if you are able to attach a certain conviction to your idea, then it does not necessarily mean that because the price has gone up, it's a bad investment. It might still be undervalued because the potential upside is significantly higher. So I think the only answer to this is to go deeper and to have a very clear-cut understanding of what really is happening behind the scenes.
And there's this very funny story of the Cuba fund. And we like to talk about India. We like to say that there's a lack of information, and we like to believe that US is a very efficient market. It is one of the most well-defined, well-versed, technologically superior markets. And Barack Obama at the time was the president. And he came along and he said that we'll be funding Cuba as the IMF, and US will be playing a major role in funding Cuba. There was a stock called Cuba, CUBA. Stock popped 300% overnight. Stock had nothing to do with Cuba, the country. And like, this is a very active example of, look at your efficient markets. So that's a funny story.
Dude, I think this Bharat oxygen thing was so funny. I remember this so clearly, like, just because this guy had oxygen in his name, he just ran up, doubled or tripled in days.
I would like to build into the whole education aspect of it again. Based on this exact conversation, should there be, like, we like to pump retail investors. We like to say investing should be a game which everyone has access to, and it is very important that everyone has access to it. Increases efficiency. But people damage their lives. A lot of people don't think about stock markets are a way for money to flow from the less informed to the more informed. And that is the basis of the game. It always goes that way, right? It is, you talk about GameStop. GameStop is a huge saga that happened 2 years ago, or like a year ago, somewhere there, where a lot of retail investors are those who are not institutions, just individual investors, start pushing money into this GameStop's stock because it was heavily shorted. It was heavily bet against on. And the most money that was made by was an institution. And then they came out with a Netflix documentary where they showed that, this institution and this institution made the most money. And they thanked the retail investors. That thank you for filling our pockets. Should there be an education aspect to it? Should there be a minimum education required to enter the stock markets? Should there be a basic exam to enter stock markets? Is there a way to solve that? And why isn't finance more of an educational topic in our schools? Why are our kids not taught finance and economics as a mandatory subject if they are going to be of the voting age at some point? If they're going to look at legislature? What is your opinion on this, the education aspect of the markets?
Adding to it, I think even if you look at another example, which is again, I think fresh in, at least I would say, assume the three of us, 2008, who made the most money? Like, you have another example right there where we look at one of the worst financial crises of the current times. Who made the most money?
Oh, absolutely. I think, the game is always skewed with the person with the fattest check. So that's always going to be there. But I mean, to answer your question, should there be, what is the solution for creating an educational barrier to someone who's wanting to enter the stock markets? So I think typically mutual funds have done a very commendable job in this space, right? So the simple idea that a lot of my people can put in very small sums of money, and then there can be an active manager who can deploy it in very simple strategies, either large cap, mid cap, small cap, whatever it is. And at the end of the day, you do not really need to worry about where your money is going in. All you need to be consistent is with deploying money into that particular fund, the method of either a single or an SIP. So I think that has solved a lot of problems per se. But when it comes to individual stock picking and investing, I think that is one area where definitely there is a lot of mis-selling which happens, especially, with the last couple of months, the SEBI coming down hard on influencers, wherein, people would have really run pump and dump schemes on Twitter, on Instagram, on Facebook, creating Telegram channels, taking in certain...
TikTok. TikTok was a huge portfolio management service at one point.
Absolutely. Any social media for that. Not only do they charge you for access to what is to be invested, but what they are then asking you to invest is also bullshit. So you're actually getting to buy a ticket to buy bullshit. So I think, that's really bad. And I think regulators are now doing a very, very hard-handed approach to these influencers, for that matter, wherein all of this has gone wrong. They've woken up a little late. They should have made these much tighter, maybe a couple of decades back, because people who are in the stock market, they understand, the indoor segment, wherein there were a lot of brokers who were again duping people of money by getting them to invest in small cap and mid cap companies which had nothing but they were completely operated stocks. So while this has been going on for a while, I think maybe not stocks picking skills should be a mandate to get into the markets. But before, say, people are allowed to open a demat account, there should be a definite educational initiative by either the exchanges, or by the brokers, or by SEBI for that matter, that these are the 10-20 pitfalls which are there when you invest into direct investing. And this is to a certain extent being implemented by Zerodha. So day before yesterday, when I logged into my Zerodha account console, I got a pop-up saying that 9 out of 10 F&O traders lose money. This is the average amount of money lost by every F&O trader. This is, even if you make money in F&O, this large portion of your money will get absorbed as fees and expenses. So I mean, those kind of disclosures really open people's eyes. And I think rather than a standardized exam, which will obviously get outdated in a month or so, a developing disclaimer system or a refresher course for anyone who's in the markets is what is maybe a easier and a better solution. And a very realistic scenario, someone who works in my organization itself, he came up to me and he told me that, boss, I want to do F&O. So, I asked him, do you really think people in F&O are going to make money? So he said, yes, my friend started and he invested, 10, 15,000, he's made certain money, and, he's able to do this, able to do that. And I actually just opened up my Zerodha website console, and I showed him the 5 simple pointers which Zerodha had very prominently displayed on its website. And 5 minutes later, I did not have to convince him of anything else. He was fairly educated enough to understand that F&O is maybe something which he should not try with very limited capital and very limited understanding. So I think that is a very good starting point, and so on and so forth we can build.
For our viewers who do not know what F&O means, F&O are futures and options. Futures and options are generally used as hedging strategies. So what that would mean is, if I believe that my portfolio is at risk, I want an insurance against it, I can use a futures or an options contract in either of the directions, up or down. And that helps me reduce my risk However, these are zero-sum games, which means that there is no value being created anywhere. The value is just transferring from one pocket to the other. So when you see someone who says that I made 10x money on my options trade, somebody actually lost 10x money on their options trade, which is how they made their money. So it's, again, like financial education by itself gets very complicated very fast with so many terms that are thrown at you. It's very simple at the core of it. It is like a very fundamentalistic game. The reason why I wanted to build from this education front is stock markets, the highest end of investments. The stock markets are for a given few businesses. We like to say there are 5,000 businesses who are public, or there are 10,000 businesses who are public. In actuality, just in India, there should be around 3 CR businesses in total. Right? Maybe more. Maybe my number is completely off. That's just 2% of our country, right? So, do you believe if we can solve this education thing, that there can be a decentralized market where the onus of investment is not just with those who have big fat checks, as you said? For example, your platform is trying to do something of that sort. These companies are not IPO'd yet. They will be IPO'd. Next step is, these companies are up for an angel round of investment. Why not get the people to fund them instead of the VCs who have bigger access to money? Or these companies are up for a private equity round. Let me gather 2 million people and let us get $20 million to them with $10 from, which is what an IPO is. An IPO means I wish to raise more money so that I can expand my business, which people completely look over that fact. For people, stocks are things जो ऊपर जाता है, नीचे जाता है, side by side जाता है, dance करता है. Not that, right? It's a means to raise money for companies. What about this decentralized aspect? Is it possible? And what extreme steps or extreme infrastructure do we need for your company and number of them like you to become something of this sort?
Just one thing on finishing up with the earlier points that we were making. You're saying that, Zerodha is giving you a thing on futures and options. I think we've all grown up watching cricket on TV, and there's been ads for mutual funds and things like that. And at the end of every advertisement, it very clearly says mutual funds are subject to certain risk. Please read the documents carefully before investing. Every single thing that we buy today, like a pack of cigarettes has a thing on it which has, all the risks. However, I think because of seeing these risks so many times, every time someone smokes on the cinema, on like any movie theater you go to, there's a disclaimer on the side that says cigarette smoking is dangerous, smoking will cause you harm. If someone takes a drink, is drinking alcohol, it says alcohol is injurious to health. These things, we're so used to these warnings and signals popping off that I think in some way our brain just sort of puts them aside. We have a filter in our brain which just tunes them out. I'm sure, Abhishek, I'm sure have seen this. I don't know, Akhil, how much you might have seen this, but every time you go for a movie in India, you have that stupid smoking ad where there's this guy lying on the bed, coughing away, being like, oh my God, I've become such a burden on my family. And they...
मेरा नाम मुकेश है, मैं cigarette,
yes,
तंबाकू खाता था, something. The dude is still alive, by the way. He is not dead. He is an actor, for the people who don't know.
Whatever he is, it's such a disgusting advertisement that you just sort of block it out. I don't think, there's certain, I think that I've seen myself at least just like try to just very actively not take that in. So I think that the number of warnings we receive on a regular basis, today you sit in a car and your car door is open and the car goes ting, 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 ting until you shut the damn door. So we're inundated, I think, with warnings all over the place. Your laptop reaches 20% battery, you get a warning. Your laptop reaches 10% battery, you get a warning. It reaches 5%, you get another warning. So the number of warnings we receive, I think our brain has just programmed itself to just shut out these warnings. And it's only when you put your hand in the fire and you get burnt that you think that, oh shit, why was there no warning? And that's when you add another warning that says, oh yeah, don't touch fire, it's hot.
Well, I think that's a brilliant one. I think definitely people would sort of, maybe just block out the warnings, but, maybe you have to just be creative with how you're putting it up. And, the more data driven it is, the more hard hitting it is. Maybe at some point of time, at least a certain percentage of the people reading it actually go through it and are actually, become a little wiser.
What do you think about these decentralized systems? And do you think these decentralized systems can actually be built given that we are able to educate society? Or given that we have a better definition of an accredited investor?
So I think, we've come a certain way from, say, the last decade in decentralizing access to capital, with all of the angel networks coming up, with all of the platforms coming up, with so many crowdfunding websites popping up. What remains to be seen is how these investments really pan out, and have these angel networks, platforms being able to sort of make the investment proposition safe enough for an investor also. So while there is the dreamy goal of generating a 10x or 20x or 100x on your startup investment, typically what needs to be understood is the quality of deal flow with the angel investors also so high that they are generally able to generate that kind of a multiple, right? On the aspect of regulation, what I think is India is still trying to protect its people from bad investments, and it is really trying to hold it together, which is why the norms for, say, raising capital from people are very, very tight in India, right? So essentially, for someone who's raising capital, you cannot go to more than 50 people. That's actually a SEBI norm, that if you're raising a private round, you cannot reach to more than 50 people, or I missed the number, maybe it's 50 or it's 100, but whatever it is, there is a number attached to it. So I think what needs to be done is definitely there needs to be a segregation of investors who can afford to lose a little money, or can afford to remain tied up for a longer period of time, or can sort of afford to take the power VC law dynamics into function. And out of my 20 investments, 18 are gonna fail, and 2 are gonna go 50x, and therefore I'm gonna get my fund back and then some to sort of make my next couple of investments. So that segregation would be important, and also regulation, but not stifling regulation, in the sense that you don't try and tune out all of the people trying to generate new methods of investing, but you do regulate them in the sense that either you get a self-regulating body in place so that there's a check on mis-selling, you get some regulations in place as to who can invest, you get some regulations into play as to how does the disclosures work out, to ensure that you're using the right instruments to get the money in. So I think work needs to be done on building the ecosystem. And once the ecosystem is there, the market would automatically grow and develop to it, right? So let's take, say, a company which is got an incorporated 10 days back. I feel in the Indian ecosystem, there is someone to fund it at every stage now. So even if you started with an idea, with nothing else than an idea, you would still find people to invest into your idea by, micro VCs who are into ideation investing. Then once you have a POC, you could go to an angel community, you could go to an angel network, you could raise your pre-series. If you are then able to get to the next stage, you can get a certain level of larger syndicates, larger operator-led investing communities into play. You can raise follow-on rounds from your angel communities and try and do a Series A. Once you're at Series A, you have innumerable sources of capital, right? From raising debt from certain platforms based on your revenue financing. You can raise debt from government agencies like SIDBI, like MSME, wherein you get a certain amount of loan if you're able to do a business logically and well. And then you'll have a lot of people who are then ready to take you from Series A to Series B. Now, say you feel that you're at Series B, you are at a good stage wherein you want to go for an IPO. Both the exchanges now have a very vibrant SME platform wherein you can list a company with even, say, a 50 crore revenue base. And at that point of time, you can actually choose to list, grow in the public space, grow to a scale wherein you are eligible for a NSE main board listing, do a relisting, get more people, do an FPO, raise more capital, and then grow your business. If you still choose to grow in the private space, and if you're able to score a couple of VC investors, you can actually grow to a multi-billion-dollar scale and then decide to list. Or maybe you can actually, if you become self-sustaining, you need not even list. You can actually just give your investors an exit. So what I'm trying to essentially pull is that the participants are ready. The people trying to raise capital and the people who are wanting to put in capital are both ready. It is just that the ecosystem needs to be put into place and everything will start running very smooth. I think we have reached that stage wherein uh, all of the moving parts are now there. And it is just that the right lighting and the right sound system need to be placed to, get the people dancing.
Abhishek, you spoke about exits. How do you deal with exits? When do you say enough is enough? This is a good point to exit, or this has gone bad enough, now I should exit. What are your methods? I think bad enough is easier. How do you decide that this is enough good? How do you say, okay, something has gone 200x, 300x, it's not going to go 400x. Or it's gone 150x, it's not going to go 200x. What is the, what's the thing?
I think I don't really measure an exit necessity in terms of how much the investment has gone up, but more in the terms of has the intrinsic value been achieved, or is the price now more than the intrinsic value of the company? So say a company which was doing excellently well and it is still doing excellently well, but the price for some reason has simply popped off and it has gone 80x its earnings. And at that point, I do not see that the company will be able to live up to the heightened expectations of the market. That is typically when a time when we start looking for an exit option. The second possibly would be in terms of shift in my asset allocation strategy, right? So this is from one of my conversations with a very senior, a founder of one of the largest institutions in India today. So he said that when we look at clients' returns, we have seen that the largest portion of return has been generated because of shift in asset allocation and not because of sort of picking the best investment within an asset. So what he meant was the largest contributor to returns for my portfolio is not that I picked stock X in place of stock Y, but that I decided that right now it is a better time to be in debt rather than in equity, or it is a better time to be in gold or in real estate rather than in equity or debt. So sometimes, even though the investment still might be okay, but we simply have a view that the equity markets in itself has gone a little too high or a little too low, and therefore we might tend to do a reallocation there. And in such cases, even though the company might still be okay, macroeconomically, we find that the equity markets, when they take a beating, everyone will go down. So we might exit in that case. So I think these are the two instances where we generally...
For me, two types of things qualify as assets. One is something that will generate money in the future, like a business. A business in the future will make money, will make profits. The profit will come back into the system or will be distributed to me as a holder of the company. Or if I own a bond, the bond will in the future generate fixed income, period by period. Somebody will give me more money and I will make my money. So that can be priced today, can pump up the value or whatever based on discount rates. That's technical aspects, but that's the onus of things of value. The other is that I own something today, tomorrow someone will value it more than I paid for it today. For example, gold, for example, Pokemon cards, for example, real estate. Unless it is rented out real estate, that is a different issue. But if I buy a house, live in it, I am not making any money on the house. I'll make it when I sell it. Hopefully somebody buys it more expensive for me. There are numerous companies which are trying to build stocks out of these things. It's called securitization, cutting these bigger pieces into smaller pieces and then selling off the smaller pieces. There's this company called Equity Zen, which are doing something very similar to what you're doing. All of these companies are in the US. So what Equity Zen does is they get pre IPO companies, angel companies, VC companies, and they try to list them on their own little platform. On their platform, you can go as an accredited investor, buy small pieces of the company.
We work with equities.
Oh, interesting. Then there's another company called Edley. What Edley does is they have education loans, and you know how the loan will start paying off 2 years down the road once the student is graduated, gets a job, starts paying it back. So I'll buy pieces of loan of Edley, right? There's this company called Masterworks, which is doing paintings, in which you can buy pieces of paintings, and then the paintings later you can get them revalued and sell those pieces for a higher value. I wish to talk about some of the other kind of assets. I think you brushed over them very quickly when you were like in the initial phases of your introduction. But what are some of the other kind of assets that you are treating and that you're willing to securitize and that you're wanting to provide to people?
So I think overall there has been 3 buckets of asset classes, which are essentially what we started off with, maybe even say 100 years back. So it's either equity, which is a portion of a company, or it is debt wherein you're loaning some money, or it is real estate wherein you're buying a piece of a hard asset. Or there have been innovations in all of these 3 fronts. I think with debt, there has been a lot of innovation. So now, maybe earlier when you thought of debt, there was only FD, which you could have done with a bank and therefore debt exposure, or you could have participated in some listed debt. Typically, this would yield you yield an investor between 7 to 9% basis what risk profile is choosing. But today there are a lot of other options which are available. So the first one, which is very simple, very easy to understand, is P2P lending, right? So P2P lending, to touch upon, what it does is RBI has given a license to certain classified NBFCs, which is called a P2P registered NBFC with RBI, wherein you, with certain disposable cash, can put up certain amount of money to that NBFC or to that company, and they can then lend it outwards to, say, someone else who's looking for a short-term loan. And the person, if taking the loan, would be taking it at 15%. You are lending at 11%. So the company is able to generate a spread of 4% in between, right? It's as simple as that. It's the exact operation which a bank does in a much more simplified manner, right? Typically, these large players in P2P in the Indian space have done reasonably well. So they have reached a size where they can boast an AUM of anywhere from 1,000 to 1,500 crores. Till date, the largest of the 5 platforms actually claim 0 NPAs. So they say that even during COVID, when people have denied paying loans, when RBI had given an open clearance that no EMIs are going to be due for the next 6 months, and therefore there was a higher rate of delinquencies, they were able to manage their loan portfolio so well that they were able to return all of the interest, land the principal in due time to all of their investors. So I think that stands as a huge testament to how well P2P has run in India. Just touching upon P2P, if you look at this same model in China, it had failed terribly. So at some point of time, there were 76 P2P companies in China. Today, there are 2. 74 companies actually shut down within a span of 4 years. The largest problem being there was no regulation. So they all operated shops as they wanted. They all took in money from whoever they wanted. They all lent it to whoever they wanted. But slowly and steadily, all of them had to shut down. But India worked out really well. RBI was very, prudent in introducing regulations on P2P very quickly, making sure it was a licensed game, making sure the players who were operating in this space were getting adequate regulatory coverage. So that's one. Second, in the debt space is definitely access to curated bonds, in the sense corporate debt, in the sense real estate debt, in the sense of maybe even government debt. So typically there are people who would want to invest for a very long term. So in such cases, there are much safer options to an FD, something similar on the similar lines as we were discussing. So there are 10, 15, 20-year government of India deep discount bonds available. So you can buy a GSEC today for $90, and the GSEC will be redeemed at some point of time for, say, maybe $100, and you will generate a 7.5% IRR on your investment, which is guaranteed by Government of India. And on the interim, there will be no cash flows, so you'll not be paying any tax also. So essentially, an FD on which you are on a annual basis paying a 30% marginal tax rate, in such a bond, if you are not in need of money immediately, why don't you simply do a why don't you simply do a deemed discount bond by the Government of India? So while options like these always existed, I think a lot of platforms have now bought it too light, and because of the growth of maybe YouTube and Instagram, they have also been able to spread this message very quickly and very easily. Third, on the debt front, possibly the last angle is of managed net funds, which have come up in the form of AIs for larger ticket holders. So in India, what we generally understand as debt is the best debt, which is AAA rated, which is going to give you 6-7% return. But the debt market has a lot of tranches, and typically, apart from this 7%, the rest of everything was being taken up by institutions. Now, because of a lot of funds which have come in, they have opened up the area of what fund managers call performing credit. In the sense, these are companies which are banked, which are EBITDA positive, which have a good business, but they're not so large that they'll get a very large line of credit from the banks. And in this particular space is where these funds have come up. They are able to generate a return of 13%, 13.5%. by giving loans to people wherein, or companies wherein, typically either banks have shied away, or because of certain regulations they have been disallowed, or simply because banks had too many people to lend to, they never paid attention to these people. Right? And with a very decently managed portfolio, they are now able to return 13.5%, 14%, which is almost twice what you would generate on an FD. So I think on the debt side, these are the 3-4 developments which is happening. Some companies are now doing asset leasing. Asset leasing is very simple. You want a car, you can't fund it, so someone funds the car for you, and the car remains in your name till the final payment comes to you. And in the interim, you pay out EMIs to the holder of the asset. Essentially, this again was a fiefdom of the large financial institutions. A lot of companies have now, or startups have now stepped into this place and given you asset leasing opportunities. Say if a Ola or an Uber wants to buy 100 cabs, and they don't want to, or they don't have the capital to buy it, you can essentially put in small checks, bring them together, buy 100 cabs, put in a trustee to manage those assets, and the drivers, from whatever they earn, they are able to pay you back small and tidy sums in the form of certain EMIs, which is a mix of both principal and interest. I think that's asset leasing. On the real estate front, there is fractional real estate. So typically, when we talk about real estate, you would look for an office, you would look for an house, you would look for a warehouse if you are a larger investor, and invest and buy it off, get it ready to move, and then find a person who can rent it for you. What were the challenges? You would have to be an expert in understanding the which asset is a good asset. You would have to understand how can you buy that asset. You would have to be an expert on doing legal due diligence into buying that asset. Then you would also have to be an expert into getting the asset ready for someone to rent it out. And then you would also need to find someone who is ready to rent out. And then you would have to ensure that you are getting the rent collections in time, you're able to get the escalations in time, you're able to manage the assets. But this, while a lot of people used to do it on their own, obviously it used to become suboptimal because this is not what their prime goal is. So in the real estate space, a lot of companies have come up who help you get into simple grade A managed office spaces wherein it is already pre-leased by a very large MNC tenant or a very large corporation. And you can easily generate a rental yield of anywhere from 7 to 8% and target maybe a capital gain of another 5 to 6%, netting you a sweet 12-13% on a longish investment with the benefit of a hard asset backing your investment. Right? So that's on the front of real estate. Lastly, on the equity front, I think broadly, apart from the MFs and the direct stock investing, now you have, what we discussed earlier, you have all segments open to you. You can choose to invest into an idea. You can choose to invest into a proof of concept established company. You can choose to invest in a growth stage company. You can choose to invest in a pre IPO company. So I think there are people solving for each of those. There are good assets available in each of those.
Abhishek, how do you make money? How much money have you made? If you're comfortable with the financials, we would love to know.
Yeah. So I think Altius started from a very small subset of investors who we used to work with. And today we service almost 8,000 odd individual investors on our platform, which includes certain ultra HNIs, which includes certain family offices, which includes certain corporates as well. Typically, we make money on the spreads which we have in pre-IPO and the distribution fee which we are able to generate from the other assets which we onboard onto our platform. In terms of broad numbers, we do around 250 to 300 crores in investments through our platform. Typically, because this is a transaction-led platform, we do not have a AUM kind of model. But in terms of transaction, we do close to 250, 300 crores.
How does one reach you? How does one get in touch with you? What is your,
Altius as a platform has been built in a model wherein you could essentially sign up, complete your KYC, look at assets, choose to invest in those assets, complete your transaction, everything online without the need for, getting in touch with someone. But on the website, there are more than one places wherein details of our support numbers are there. So I think any investor can choose to get in touch with their respective RMs, a general support number, and get whatever access to whatever information they need.
We would love to have a little Thought Bistro promo code for your audience, if you can provide some added value to them.
Not shop. I think that's certainly possible. We'll make that happen.
Love it, yeah. So, dude, I think this has been a very information-heavy episode. There's a lot to break down. There's a lot to process. And funnily enough, our last question, which is a tradition on our podcast, which the previous person has left behind for you, has turned out to be very, very topical. And all the question about funding, it's come back to funding again. So we all agree that the whole concept of bootstrapping is a very difficult thing. You don't know how long it's going to take for you to earn that money, as we gave the example of the airplane. You don't know when the airplane is going to fly, and once it starts flying, you don't know when it's going to reach its destination. So when one is bootstrapping, would you think of spending 10, 15 years and growing it at a steady pace? Or would you think of growing very quickly, getting funding and growing at a much more rapid pace? What is your opinion on these two, and what do you think, what is your preference of the two alternatives?
Sure. So I think generally it would actually depend upon the industry which you're in, right? So if it's a winner-take-all market, there is no point going slow. So you'll have to sort of get all the funding which you need, go all in. Otherwise, someone else will come and take over the market, and then you'll be left, standing in the way. But if it's a business wherein a more thought-out approach makes a lot more sense, in the sense it's a regulated space, therefore you cannot go and break things, and maybe if you try and do that, you'll not be able to get through, but you'll crash and burn. Or if it's a space which is undiscovered or people are not ready to fund it, in those cases you'll be forced to sort of bootstrap your way, build it slowly, then maybe get a little more funding and then go a little faster. So it truly depends upon the space which you're building, the area which you're competing, how your competition is behaving, and also on your own DNA. So if you are someone who's a little cautious, then you cannot really go that aggressively into things. And if you're something who likes to do things very quickly, you might not have the mettle to actually do it very slowly. So it has to be a mix of how you operate as a founder and also what your industry needs you to do. Typically, in our case, I think it's a mix. So we grew to a certain scale on our own. At that point of time, we realized that the alternate space is heating up, and therefore we need to go faster now. At that point, we raised some capital. So we raised about close to $1 million about a year and a half back, and then we decided to scale further. So we made investments into technology, we made investments into marketing, and the idea was that we think that India is at a cusp wherein people now understand these investment classes, and we want to reach more and more people much more faster than we otherwise would have. So, it's a I think a mix of how the founder sees the space and how the space sees the founder.